The last few weeks have been intense. Markets moving fast, headlines everywhere, fear building. And if you're not careful, you start thinking that you need to act. But reacting to headlines is one of the most expensive mistakes investors can make. And let me show you why. Every time something major happens, war, crisis, uncertainty, the market reacts immediately. We have sharp drops, red everywhere. And it feels like something is breaking, but here is what history shows. The initial reaction is emotional, but recovery is all but guaranteed. If we look at any major geopolitical events, market drop quickly. But in many cases, they recover within even a few months. Because don't forget that companies don't stop operating and economies don't just stop overnight. Fear is immediate, but fundamentals take much longer to change. And if we look 2008 as an example, we can see that we had a massive drop, which was the major financial crisis. So the index was down for only a few years, basically. But anything that you bought around year 1 or 2, you would have more or less doubled when the markets reached the previous heights. If we look at 2011, we had the EU debt crisis, as well as the US credit rating downgrade. In 2012, we had more EU debt fears. In 2015, we had issues with China. They decided to devalue their currency. And we had several more issues here. Looking at 2020, we know this was COVID. Very abrupt, very violent, full of fear. But I want to show you something else. Look at this. If you stayed invested throughout the whole period since 1987 till 2025 December, you would have had 600 and with 10,000, you would have had 600 and you would have 616k. This goes against what many people think, that it's better to time the market and try to sell before things go down and so on and so forth. If you only missed the 5 best days, you would have 380k. If you miss the 50 best days, you would have 44k. And what does this mean exactly though? Let me change this to a daily view and I will show you. So we had the last few days of a downturn, but then just one day yesterday we had 1.6% green on the S&P. This is one day. Imagine if you missed 5 in total, you would have a much smaller return in total. This is a very good article and I will share this in the comments below, because this is very important. You should be aware that investing has volatility, but ultimately volatility is what keeps the market going up, especially if you invest throughout any downturn. So basically the best days in the market often happen right after the worst days. And so when people panic and sell, they don't just avoid losses. So for example, here you wouldn't have just sold and bought back. If you were to buy back once things are green, 1.6% down and 1.6% up, the delta is around 3%. So you would be at a quite big loss. So people usually miss the recovery that way. And most people think I'll sell now and I'll come back later, but the reality is that you don't know when later is, nobody knows. And missing just a few days completely destroys long-term returns. So, in summation, volatility feels dangerous, but reacting to it is often far more dangerous. Markets reward patience, not emotion.